Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone, and thanks for the opportunity. Uh, Today we are from the group one. We'd like to present about the material for this meeting. So, before we move to our material, I'd like to introduce you to our group members. So, first is me, Lazuardi Imani, with student number 047. Second is Febriani Sarwinda with student number 218. Third is Bertalia Permata Putri with student number 440. And the last is Tunambar Sari 441. So without any further ado, let's get started. Okay, next. Okay, uh, in this time, we'd like to explain about the chapter 7, which is the measuring and controlling assets employed. Next. First thing first, in this chapter, we first discuss about the principal types of assets that may be employed in an investment center. So the sum of this asset is called the investment base. So we then discuss two methods of relating profit to the investment base. So the first um, is the percentage return on investment referred to as ROI, and second is economy value added called EV, EVA. And we described the advantages and qualifications of using each to measure performance. Finally, we discussed the somewhat different problems of measuring the economic value of an investment center as compared to evaluating the manager in charge of the investment center. So, next. Okay, the first we'd like to discuss about the structure of the analysis. So in our examination of the alternative treatments of assets and the comparison of ROI and EVA, the two ways of relating profit to assets employed, we are primarily interested in how well the alternatives serve these two purposes of providing information for sound decision making and measuring business unit economic performance, because we know that in general business unit managers have two performance objectives. So the first, they should generate adequate profits from the resource at their disposal, and the second is they should invest in additional resources only when the investment will produce an adequate return. Conversely, they should disinvest if the expected annual profits of any resource discounted at company's required earnings rate, so are less than the cash that could be realized from its sales. So the purpose of relating profits to investment is to motivate business unit managers to accomplish their objectives. So as we shall see, there are significant practical difficulties involved in creating system that focuses on assets employed in addition to the focus on profits. So next. Okay, our primer uh, topic or things that we'd like to discuss is ROI and EVA. So we have to know first that ROI is return on investment, which is a ratio. The numerator is income as reported on the income statement, and the denominator is assets employed. But EVA is economic value added, which is a dollar amount rather than a ratio. So it is found by subtracting a capital charge from the net operating profit. And these two will be explained more by my friend. Okay, next. So we will discuss about the measuring assets employed. So there are lots of items. We will start with cash. So most companies control cash centrally because central control permits use of a smaller cash balance than would be the case if each business unit held the cash balance it needed to weather the unevenness of its cash inflows and outflows. If the about the receivable, which is the business unit managers can influence the level of receivables indirectly by their ability to generate sales, and directly by establishing credit terms and approving individual credit accounts and credit limits, and by their vigor in collecting overdue amounts. So in the interest of simplicity, receivables often are included at the actual end of period balance. Although the average of intra-period balance is conceptually a better measure of the amount that should be related to profit. And the third is inventories. So inventories ordinarily are treated in a manner similar to receivables, that is, and they are often recorded at end of period amounts, even though intra-period averages would be preferable conceptually. And the next is working capital in general. So as can be seen, um, treatment of working capital items varies greatly. So at one extreme, companies include all current assets in the investment base with no offset for any current liabilities. At the other extreme, all current liabilities may be deducted from current assets as was done in calculating the investment base. So the next is property, plant, and equipment. So in financial accounting, fixed assets are initially recorded at their acquisition cost, and this cost is written off over the asset's useful life through depreciation. And most companies use a similar approach in measuring profitability of the business unit's asset base, and this causes some serious problems in using the system for its intended purposes. So the system to measure about the property, plant, equipment, there are five systems, which is the first is acquisition of new equipment, second is gross book value, third is disposition of assets, fourth is annuity depreciation, and the last is the other valuation method. Um, Next is list assets. So the business unit's income before taxes would decrease because the new rental expense would be higher than the depreciation charge that was eliminated. Nevertheless, economic value added would increase because the higher cost would be more than offset by the decrease in the capital charge. Because of this, business units manager are induced to lease rather than own assets whenever the interest charge that is built into the rental cost is less than the capital charge that is applied to the business unit's investment base. And the next is idle assets. If a business unit has idle assets that can be used by other units, it may be permitted to exclude them from the investment base if the classifies them as available. So the purpose of this permission is to encourage business units manager to release underutilized assets to units that may have better use for them. The next is intangible assets. So some companies tend to be like they have the R&D intensive, like if they running business in pharmaceutical or that need further examination and also research about that. So they spend a huge amount on developing new product, and other tend to be marketing intensive, like the consumer products firms such as Unilever and so far and so on. There are advantages to capitalizing intangible assets such as R&D and marketing, and then amortizing them over a selected life. So this method should change how the business unit manager views this expenditure. And the next is non-current liabilities. So ordinarily, a business unit receives its permanent capital from the corporate pool of funds. So the corporation obtained these funds from debt providers, equity investors, and retained earnings. To the business unit, the total amount of these funds is relevant, but not the sources from which they were obtained. And the next is the capital charge. Corporate headquarters sets the rate used to calculate the capital charge. It should be higher than the corporation's rate for debt financing because the funds involved are a mixture of debt and higher cost equity. So usually the rate is set somewhat below the company's estimated cost of capital so that the economic value added of an of an average business unit will be above zero. And the last is surface of practice, which is the practices in investment center management, and they try to find the most suitable practice that they want to apply. Okay, that's all from me. And the next will be delivered by my friend. Thank you.
Okay, thank you. Going to the next slide. Okay. Okay, for this slide, I want to continue my friend explanation before. That is about EVA versus ROI. So, like my friends has explained before, that most company employing an investment center evaluate business unit on the basis of ROI rather than EVA. And ROI is a profit divided by capital, and also EVA is a profit less the fuel cost of the capital itself. So ROI is a ratio and EVA is a fully loaded measure of profit. Okay, maybe we going to the next slide directly, guys. So the first or in this slide, we will discuss about there are three apparent benefits of an ROI measure. That is, the first is about it is a comprehensive measure in that anything that affect financial statement is reflected in this ratio. And the second is ROI. It's a very simple to calculate, easy to understand, and also it will be meaningful in an absolute sense. I have an example that an ROI of less than 5% is considered low on absolute scale, and an ROI of over 25% is considered high. So the next is about the common denominator that may be applied to any organizational unit responsible for profitability and also regardless of size or type of business itself. And then the performance of different units may be compared directly to one another or to the other. Also, for the ROI data are available for competitors and can be used as a basis for comparison. And the dollar amount of EVA doesn't provide such as a basis for comparison. Nevertheless, the EVA approach has some inherent advantages. So, as we should always remember that there are three apparent benefits of an ROI measure, like that. And going to the next slide. In this slide, we will talking about four compelling reasons to use EVA over ROI. And for the first, with EVA, all business units have the same profit objective for comparable investment. So the ROI approach, on the other hand, provide different incentive for investment across business units. For example, let me say about a business unit that currently is achieving an ROI of 30% would be reluctant to expand unless it is able to earn an ROI of 30% or more on additional assets. A lesser return would decrease its overall ROI below its current 30% level. So this business unit might forget about the investment opportunities whose ROI is above the cost of capital but below 30%. And the second compelling is about the decision that increase center's ROI might decrease its overall profit. Let me say, for instance, in an investment center whose current ROI is 30%, that the manager can increase the overall ROI by disposing of an asset whose ROI is 35%. However, if the cost of the capital tied up in the investment center is less than 25%, so the absolute dollar profit after deducting capital cost will decrease for the center. The use of EVA as a measure deal with both these problems. So they relate to asset investment whose ROI falls between the cost of capital and also the center's current ROI. And the third compelling reason to use EVA over ROI is the advantage of EVA is have a different interest rates may be used for different types of asset. For example, let me say a low rate may be used for inventory, while a relatively high rate may be used for investment in fixed asset. Furthermore, the different rates may be used for different type of fixed asset to take into account different degree of risk. And in short, management control system can be made consistent with the framework used for decision about the capital investment and resources. And then for the allocation, it follows that the same type of asset may be required to earn the same return throughout the company, regardless of the particular business unit's profitability. This business unit manager should act consistently when deciding to invest in new asset or the other investment. And for the less compelling, or for the fourth compelling, is about the advantage that EVA, in contrast to ROI, has a stronger positive correlation with change in a company's market value. And then the shareholder are important too, because the stakeholder is there's an in company, so there are several reasons why shareholder value creation is critical for the firms. And also it can reduce the risk of takeover. It can be create currency for aggressiveness in merge and also acquisition. And the last, it can reduce cost of capital, which allow faster investment for the future growth for the company itself. Going to the next slide. Okay, we want to talk about the measures of EVA. Like you can see at the screen that the formulation to find EVA is net profit minus with the capital charge, where this capital charge is come from cost of capital times by capital employed. And also we can find the EVA in another way. In this formulation, that is capital employed times with ROI minus by cost of capital. So this following formula or action can increase EVA, like we can see at this equation or formulation. It can increase in ROI through business process re-engineering and also productivity gains without increasing the asset base. And also the investment of asset, product, and or business whose ROI is less than the cost of the capital itself. And then the aggressive new investment in asset, product, or business whose ROI exceeds the cost of the capital. An increase in sales, profit margin, or capital efficiency that have ratio of sales to capital employed, or it can be decreased in cost of capital percentage without affecting the other variable in equation. So this action is very clearly are in the best interest of shareholder. Now, in this slide, we will see what is the difference between ROI and also EVA. Maybe only see this table, you can directly know what is the difference between the ROI and also EVA. So the differences between ROI and EVA is shown in this slide, in this table. In here, we assume that the company's required rate of return for investing in fixed asset is 10%. We assume it's also 10% after tax, and that the company wide cost of money tied up in inventories and receivable is 4% after tax. Okay, the rate is, or the, what is that? 4% after tax. And the top section of this table is about the ROI calculation. So the first column until the 5 columns show the amount of investment in asset that each business unit budgeted for the coming year. And the 6th column is the amount of budgeted profit, and also the 7th column is the budgeted profit divided by the budgeted investment. Therefore, this column shows the ROI objective for the coming year for each of the business units. Only in business unit C is the ROI objective consistent with the company's cut-off rate, and it no unit is the objective consistent with the company-wide 4% cost of carrying current asset. Business Unit A will decrease its chance of meeting its project objective if it didn't earn at least 20% of added investment in either current or fixed asset, whereas Unit D and also Unit E would benefit from investment with a much lower return. So EVA correct this inconsistency. This investment is multiplied by the appropriate rate, are subtracted from the budgeted profit, and the resulting amount is the budgeted EVA. Periodically, the actual EVA is calculated by subtracting from the actual profit or the actual investment that multiplied by the appropriate rate. So why in like I mentioned in the 11th slide that most company is more use EVA rather than ROI because EVA itself has many advantages that if we compare with ROI, and also the EVA have many consistency is if we want or if we look at in this table that for example the rates for EVA method, the rates for the current asset is always consistent, and also the rate for the fixed asset is also consistent. So that was why many companies use EVA method rather than ROI methods. Okay, that's all about the ROI versus EVA, and for the next presentation will be explained by my friend.
So hi everyone, here I'm Berta with student ID 440. We'll continue the explanation. So here I'm going to explain to you about the additional consideration in evaluating the managers. So as I already explained before about the disadvantages of the ROI, it's actually surprising that this method is still used widely. From our personal experience, we know that the conceptual flaws of the ROI for performance evaluation are real and it contributes to dysfunctional conduct by the business unit manager. Even if we are unable to determine to what extent that this dysfunctional conduct, but however, a few of managers actually already admit of this existence, but some of them are still not aware about this about this existence. So here we strongly recommend to use EVA instead of ROI as the performance measurement tool. Even if EVA, however, does not solve all the problem of measuring the profitability in investment center, and also EVA does not solve the problem of the accounting of the fixed asset already explained before, unless the annuity depreciation is also used, and that is really used done in the practice. But in the situation when the book value, the gross book value is used, and the business unit can increase the EVA by taking the action contrary to the increase of the interest of the company. And if the net book value is used, the EVA will increase simply because of the passage of the time. But furthermore, EVA will be temporarily depressed when the new investment, because of the new investment of the high net book value in the early years. So here, EVA does solve the problem that created by the differing profit potential. But regardless of the profitability, all the business unit will be motivated to increase the investment if the rate of the return from the potential investment is high or exceeds the required rate of the prescribed by the measurement system. But moreover, not only that, the other problem that occurs is that some assets may be undervalued when they are capitalized or when they are expensed. And this situation applies especially for the marketing units. When a group of units with a varying degree of the marketing responsibility are ranked, then the unit with the relative larger marketing operation will tend to have a highest EVA. So, so considering of this problem, some of the company have decided to exclude the fixed asset from the investment base. And this company charge make an interest charge for the controllable asset only, and they control the fixed asset with a separate by a separate device, and that controllable asset are essentially is a working capital items. And the business unit manager can make a day-to-day decision that affect the level of this asset. But it's really important to make a wise decision, because if they make a wrong decision, it will lead into a serious consequence like that. And at the end, the investment in the fixed asset are controlled by the capital budgeting process before the fact and the post completion audit to determine whether the anticipated cash flow in the fact materialize. But this is actually far from the completely satisfactory, because the actual saving and the actual revenue from the fixed asset acquisition may not be able to identify. As an example, if there's a new machine that can produce a variety of product, then the cost accounting system usually will not identify the attribute attributable saving to the each product. So that's all from me. Sorry if there any mistake that I made. And the next explanation will be explained by Donna.
Okay, I'm Donna with student number 441. Here, we will discuss about evaluating the economic performance of the entity. So, in this section, we discuss the purpose and nature of the economic information. Okay, next slide. So, as pointed out in chapter 5, reports on the economic performance of business units are quite different. So there are management reports and economic reports. Management reports are prepared monthly or quarterly, whereas economic performance reports are prepared at irregular intervals. Usually it is annually, so it's once every several years. For reasons stated earlier, management reports tend to use historical information on actual costs incurred, whereas economic reports use quite different information. In this section, we discuss the purpose and nature of the economic information. So, economic reports are a diagnostic instrument. They indicate whether the current strategies of the business unit are satisfactory or not, whether a decision should be made to do something about the business unit. For example, expand it, shrink it, change the direction, or maybe sell it. The economic analysis of an individual business unit may reveal that current plans for new products, new plant and equipment, or other new strategies, when considered as a whole, will not produce a satisfactory future profit, even though separately each decision seemed sound when it was made. Economic reports are also made as a basis for arriving at the value of the company as a whole. Such a value is called the breakup value. The breakup value is the estimate amount that shareholders would receive if individual business units were sold separately. So the most important difference between the two types of report between management reports and economic reports is economic reports focus on future profitability rather than current or past profitability. The book value of assets and depreciation based on the historical cost of these assets is used in the performance reports of managers despite their no limitation. This information is irrelevant in reports that estimate the future. In this report, the emphasis is on replacement cost. Conceptually, the value of a business unit is the present value of its future earning streams. This is calculated by estimating cash flows for its future year and discounting each of these annual flows at required earning rate. So that is our group presentation. Thank you. See you on our discussion in Zoom meeting.